Hello everybody, welcome to another episode of Erickson TV. Curtis here with Lauren. Hey Lauren.
Hey everybody.
Hey Lauren, I'm wearing black not because I'm in mourning.
Okay.
This is kind of celebrate as we speak today on this January 26, 2012. So far, year to date, the U.S. stock market is up.
Yes.
And also the international markets, which
Yes.
everybody was just going crazy about last year,
Right.
are actually up greater than the U.S. market.
Yep.
So I'm recognizing that we're in the black so far year to
Right.
date.
Okay.
But the big topical news yesterday was the Federal Reserve Chairman Bernanke and the Federal Reserve has indicated that they are planning on keeping interest rates close to zero up through the end of 2014.
Yeah, that's a long time.
So we're talking about almost 2 years from now.
Right.
So what should investors do with that information?
Yeah, that's a good question. and we wanted to do this video because we figured that a lot of people probably would at least be somewhat thinking about this. And it is unusual because, at least as far as I don't remember the Federal Reserve Chairman telling people what they were planning to do that far in advance.
That's right.
That's kind of an unusual thing. So I think that clearly they're concerned that whatever methods they've been using in the past, they maybe are not quite enough, so they want to keep interest rates low for a long time. Well, for an investor, this is a pretty complicated thing.
We do know that a lot of investors, even up through this last year, have been fleeing equities and going to
Right.
cash. So what does that mean for cash
Well,
investors?
The most recent inflation numbers are that inflation is running at about 3.5%.
Okay.
That's fairly normal by historical standards. It's actually just a little bit low. But when inflation rates are near zero, when interest rates are near zero, and inflation is about 3.5% per year, you don't have to be a mathematical genius to know you're losing money if you keep your money in things that are yielding 0%.
Right, because even if your portfolio is staying stable, it's losing purchasing power.
Yeah, it's losing purchasing power.
Each incremental increase.
And that's a really unusual situation, 0% interest rates. The other thing is that it's getting to the point now where it's not even such a good deal, even if you try to go longer term. I think that it's often easier to talk about this stuff if we talk about the kind of bonds that offer real interest rates. And those are TIPS, Treasury Inflation Protected Securities. So today, after the announcement, because of course bond prices went up after this announcement as the yields went down, I looked up the Treasury Inflation Protected Securities. So if you want to buy a bond that will protect you from inflation, you can get a 5-year bond now with a real rate of negative 1.28%. And you have to keep your money there for 5 years to get negative 1% per year. If you go out 10 years, and this is really unusual, if you go out 10 years, you can buy a bond that will pay you a whopping negative 0.2%. And again, you have to keep your money locked up for 10 years for the privilege of losing 0.2% per year. In order to get a positive real return from treasuries, you have to go out to the 20-year treasury, which is really volatile.
Right,
that thing goes up and down, and then you can make 0.34%.
I mean, that's volatile like a stock is.
Yeah, yeah, very close. So you can make then 0.34% per year.
Okay.
For locking your money up for 20 years.
So the only reason I could see that somebody would put a huge part of their nest egg exclusively in that type of investment if they wanted to have absolute certainty of what their money was going to be at the end of a term, for instance.
Yeah, exactly. So if you just need to know exactly how much in real dollars you'll have 20 years from now, and you need absolutely no growth, this might be a good deal. For everybody else, I think that now is one of the strongest cases in history for why having at least some money in the stock market is usually a good idea.
And when we mean by stock market, it means diversified, globally, and different size companies.
Yes, exactly. If right now, if you put all of your money in very low risk investments like bonds, you have a guaranteed negative real return.
Right.
That's just how it is.
Yeah, and the thing is that when I looked at that, the thing is even if the stock market doesn't grow particularly a great amount, the dividend yield is actually better than the interest rate that the U.S. government's paying.
Yes,
So,
that's
okay.
correct.
Well, so that's so if you like help on how to put together a diversified portfolio, Lauren and I would be happy to assist in that. And we thank you for watching this episode of Erickson TV. Bye now.
See you next time.